Welcome to this Bradley Nuttall Otago Limited Financial Markets Update. We will bring you up to speed on developments in the financial markets over the first quarter of 2020. My name is Fraser Richardson, and along with my colleague John Alexander, we'll take you through an overview of the last quarter. I'm sure you'll agree that the first quarter of this year was, if nothing else, an eventful one. Let's kick it off with a look at the bigger picture in the economy. There was really only one story in the first quarter of this year. The COVID-19 pandemic quickly spread around the world and resulted in unprecedented lockdowns that pretty much brought economic activity to a halt. While the coronavirus is first and foremost a health crisis, we'll focus on its impact on financial markets and on your investments. And we'll look at how you should react, if at all, as an investor. There's been no shortage of sensational headlines in the media, and plenty of seemingly contradictory advice out there, depending on who you talk to. Looking at how financial markets have reacted to the coronavirus, most share markets peaked around the 20th of February and went into free fall until the 23rd of March, with markets dropping around 35% during that period in most developed economies. While there's no guarantee that the 23rd of March is the ultimate low point in global share markets, there's been a significant bounce back in share values, as you'll see from this slide. The S&P 500, a broad-based US share market index, has rebounded strongly, and the Nasdaq Composite, which is home to many technology stocks including Amazon, Netflix and Apple, is now in the black for the calendar year to date. Fixed income markets have been a relatively safe harbour, aided by government asset purchase programs aimed at keeping credit markets open to larger companies. At Bradley Nuttall Otago, we recommend that our clients focus on the long term and ignore the short-term ups and downs of the markets. Most can relate to this weather analogy. The basic message is to ignore short-term changes in the weather and focus instead on the long-term climate. Fix your sights on a distant point on the horizon and shut out the short-term noise, and that way you're likely to sleep better at night.
Our model portfolios suffered along with the rest of the market in the first quarter of this year. The graph on the left shows the quarterly performance of each of our standard model portfolios over the quarter. Don't forget that this graph doesn't reflect the significant bounce back in performance since the beginning of April, which will be included in the second quarter performance figures. On the right, you'll see the annualised performance of each of our model portfolios over the last 10 years, a period that includes not only the COVID-19 outbreak, but also includes some of the period of recovery from the global financial crisis when share markets performed poorly. A good advisor's role is to make sure clients don't fall into this trap, and the rebalancing mechanism achieves this. That is, when share prices are low, portfolios will be underweight shares, hence we are obliged to buy shares in order to rebalance a portfolio, and vice versa. When shares are high, we sell and buy fixed interest to rebalance the portfolio. News and financial commentary can influence people's view of investing. Without a strong investment philosophy to guide them, people also may follow the advice of friends, neighbours or family, especially if the insight promises a fast, easy return. But growing wealth is no shortcut. Success requires a solid investment approach, a long-term perspective and discipline to stay the course. You'll notice from this graph that your average investor has had to navigate a lot of crises over the last 50 years, but still came out with a stellar return if they had held their discipline. For those reasons, we don't advocate trying to time the markets. Premiums are unpredictable and appear at different times in different places. If you try to time the market, you have to be right twice. Once when you get out and again when you get back in. Staying in your seat is usually the best way to benefit from a market recovery. Market timing can also involve hidden costs like transaction fees and incurring new tax liabilities. The key is to focus on what you can control. Create an investment plan to fit your needs and risk tolerance. Structure a portfolio along the dimensions of expected return. Diversify globally. Manage expenses, turnover and taxes. Stay disciplined through market dips and swings. A financial advisor can offer expertise and guidance to help you focus on actions that add value. This can lead to a better investment experience.
If you're still contributing to KiwiSaver, there are several steps you can take to relieve some financial pressure, such as by reducing your employee contributions, taking a savings suspension, or if you can really show that you're suffering from significant financial hardship, then you can withdraw some of your KiwiSaver funds. Some people are asking whether they should actually switch funds because of the current market volatility, such as by going from an aggressive fund or a growth fund to a conservative fund. As a general rule, we wouldn't recommend this. There may be some circumstances where it's appropriate, but they'll be very much in the minority. Thanks for watching our presentation. If you'd like to talk through your own situation, just contact us anytime by phone or email. We're working from home at the moment, but are looking forward to returning to the office once the lockdown conditions allow. In the meantime, stay safe, help others where you can, and don't overload yourself with media coverage.